The biggest storm in history is about to arrive, and billionaires always anticipate a storm coming before it actually hits. The world's CEOs, hedge fund managers, and venture capitalists are getting ready for one of the worst disasters in recorded history. Many people truly believe that a recession is already underway. They just don't realize it yet. Hey, welcome to Stock Market Mate. Today's video will explain why billionaires are selling their stocks. We'll also talk about the tactics employed by billionaires to protect themselves from the impending recession and how you may do the same. Before we get right into it, make sure to subscribe to this channel and ring that notification bell to get our latest updates. Let's begin. Billionaires preparing for downturns. The majority of the time, it is true that most people think it is hard to time the market. Although it is very difficult to time the market, you can still make plans without knowing the exact time frame. Billionaires frequently put strategies in place to protect themselves from impending crises. They'll be successful in every circumstance by hedging their resources. The only people who have their heads above water in the event of a crisis are those who have hedged their wealth. Consider Elon Musk's approach as an illustration of this. Elon is not attempting to time the market with his stock holdings, but he does believe that we are now in a recession that might last for 12 to 18 months. He views the future as a probability rather than something he knows will happen without a doubt. Because the state of the economy is constantly changing, you can never assume whether a crash will happen or not. He is simply hedging for the worst-case scenario rather than betting everything on his economic projection, which may turn out to be incorrect. In an interview, when asked about his thoughts on the current economic situation, Elon stated, "Well, making predictions about macroeconomics is never easy, so one should give these things probabilities. Ironically, I was questioned about the economy last year, and I responded, well, I think we might enter a recession in around spring of 2022. Laying off employees. Elon's actions are no different from others in that they speak louder than words. He just made the decision to lay off 10% of Tesla's salary staff to prepare for a macroeconomic catastrophe. Elon is cutting back on staff in order to preserve capital. Even though cash might not appear crucial during an inflationary environment, cash flows reign supreme during recessions. This rule applies to both enterprises and individual investors like you. The Federal Reserve has a balance sheet that is over $5 trillion in debt and intends to decrease the money supply over the next few years. This implies that the Fed is no longer free to give out money as it formerly did. Even if inflation stays high, money will become more difficult to come by if the economy collapses in the following months. Elon knows well about the difficulty in finding financing because he was in the dot-com bubble, therefore he urges companies to use any opportunity to do so. Elon. Make sure you have enough capital reserves to last throughout the unpredictable times and that you aren't operating too close to the financial brink. Due to the fact that recessions in the past have miraculously disappeared, similar to a light switch, it is flipped. Do you recall this from back when PayPal was still around and we raised $100 million in March 2000? The demand was so great that VCs literally wired money into our account without even a term sheet. They would actually find our bank account number and wire us money, and we're like, where did this come from? So in March 2000, it appeared as though money was literally being fire-hosed. The market subsequently entered a free fall in April 2000, and within a month, even solid companies were finding it difficult to raise capital. It's only crucial to keeping in mind that PayPal nearly filed for bankruptcy in 2000. Fortunately, we were able to raise $100 million in March 2000. Otherwise, it would have been essentially game over. Elon is among the top innovators, but he isn't the only one who is laying off staff. 20% of Peloton's employees were let go. Carvana reduced its workforce by 12% or 2,500 workers, while Coinbase stopped hiring new people, revoked job offers, and slashed its headcount by 18%. One thing connects all of these layoffs: macroeconomic concerns. One of the main justifications for the layoffs was the state of the market, according to Coinbase. LJ Brock, the chief people officer of Coinbase, outlined how swift adaptation and taking action now will enable us to effectively navigate this macro climate, emerge even stronger, and foster additional wholesome growth and innovation in an article. Hedging methods. Initiating short positions. There are various strategies available to protect your portfolio from market downturns, many of which we have discussed on this channel. Shorting the market is one of the most popular strategies. As an activist investor, Carl Icahn oversees over $21 billion, and recently, he has started shorting the market. Icahn is renowned for being a corporate raider. This indicates that he routinely acquires businesses, strips them of their assets, and then sells them for a profit. Icahn is undoubtedly one of the best investors of all time, despite the fact that many people despise him. From 1968 to 2014, he generated returns that were far higher than Warren Buffett's, averaging over 26% annually. Icahn explained why he thinks there might be a recession or depression coming shortly on CNBC earlier in 2022. Icahn employs a volatility strategy, necessitating the hedging of his portfolio against significant declines. Credit default swaps on mortgages for corporate buildings and commercial centers have been purchased by Carl Icahn. Credit default swap purchases are like a short sale on steroids. Icahn is essentially shorting physical stores by investing in credit default swaps on mortgages for corporate buildings and shopping centers. This protects him from his long stances. Keep in mind that hedging simply refers to safeguarding your portfolio from the worst-case scenario. It has nothing to do with timing the market. Similar tactics are being used by Leon Cooperman, another billionaire fund manager. From 1991 to 2018, Cooperman had a yearly return of 12.4% on average, which is more than 3% more than the S&P's annual return. Cooperman anticipates a recession and is currently 68% net long like Icahn. In essence, this means that 68% of his portfolio consists of long stock positions, while the remaining 32% consist of short market positions. Many of you are probably uncomfortable with the risk of shorting stocks, despite the fact that many millionaires are hedging through short holdings. According to Cooperman himself, investing in equities has historically been a reliable inflation hedge. He actually referred to himself as a fully invested bear before beginning his short position in April 2022. This indicates that despite forecasting a bear market, he had no short positions at all. Thus, he was actually only keeping equities to protect himself against inflation rather than shorting the market. Buying put options. Purchasing short-dated call options on your existing stock holdings is another well-liked hedging strategy. Cooperman, who holds long positions in all three businesses, has publicly declared that he has put options on Microsoft, Google, and Amazon. This enables him to be well-positioned for the long run while still being safeguarded against a short-term sell-off. While his stock holdings are for long-term gains, his put options serve as a hedge against short-term downturns. Buying inflation-resistant stocks. Although some investors might consider this to be pointless, you must consider beta and alpha. Beta measures the portfolio's volatility with respect to the stock market. The beta for the S&P 500 is 1. Your portfolio has a beta of 2 if its volatility is 2 times greater than the market. Your portfolio's beta is equal to 0.5 if it is half as volatile as the S&P. A component of beta is subtracted from your return to create the risk-adjusted return known as alpha. This indicates that your return for volatility is taken into account. Because you deduct beta when your portfolio is more volatile, your alpha decreases. On the opposing side, this also works. Higher alpha often corresponds to lower volatility. Fund managers aim for high alpha since it adjusts your return for the risks you're taking. Cooperman increased his alpha by hedging long stock positions with wagers like put options. Chamath Palihapitiya, a billionaire fund manager, is also arranging for a stock market collapse. He thinks that those who opt for alpha over beta will be the only ones to survive the impending slump. Allocating capital to time-tested companies. A different fund manager by the name of Jeffrey Gundlach just started a fund with a goal of addressing present and future economic problems. Through his mutual funds, which have regularly outperformed their respective indices, Gundlach oversees more than $140 billion. The Double Liner Chiller CAPE ETF, which stands for the Cyclically Adjusted P/E ratio, is the newest fund from Gundlach. In essence, this ratio modifies the P/E ratio to announce for earnings and cyclical changes. Gundlach is utilizing the CAPE ETF to identify the market's most undervalued sectors. Diversifying your portfolio. The simplest form of hedging is to simply diversify your holdings. Ray Dalio, who is regarded as the king of hedge funds because of his emphasis on alpha, uses this technique the most frequently. In nearly every macroeconomic climate, he's safeguarded by his allocation, which includes almost every asset. The assets that Dalio has in his fund are shown in this chart. As it travels up and down, the inflation on the y-axis rises and falls accordingly. US GDP growth is plotted on the x-axis. This graph demonstrates how Dalio has included his assets that function effectively in any macro environment. So in a sense, his fund is macro-neutral. He'll be able to lower volatility and raise alpha by including new asset types. This is due to the fact that you're adding uncorrelated assets based on comparable, if not identical, long-term returns, because it is essential for achieving success in the hedge fund industry. Dalio refers to this technique as the Holy Grail. Never forget that timing the market is typically never a good idea. Timing the market requires either going all in on your positions or just holding 100% cash, both of which are notoriously tough. Both of those have a poor track record and frequently result in investors losing everything they have or missing out. If you want us to go in-depth on any specific tactic, let us know. Please click the like and subscribe buttons if you like this video, and don't forget to hit the notification bell to not miss out on our new content. We'll see you at the next one. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!